Are you a UK pensioner wondering if you need to file a tax return this year? You might be surprised to learn that thousands of retirees are accidentally breaking tax rules without even knowing it. Stay tuned because today I'm revealing the 7 critical triggers that could mean HMRC expects a tax return from you, and ignoring them could cost you serious money in penalties. Hello and welcome back to UK Pension Hub. I'm so glad you're here today because we're tackling one of the most confusing questions facing British pensioners right now. Do you actually need to submit a tax return to HMRC in 2025? Now, you might think that once you retire, your tax affairs become simple. After all, you're not running a business anymore, you're not juggling multiple income streams, you're just collecting your pension and enjoying your retirement years. But here's the thing, the tax system doesn't quite work that way, and there are specific situations where HMRC absolutely expects you to complete a self-assessment tax return, even if you've never had to do one before in your entire working life. Today, I'm going to walk you through the 7 key triggers that mean you probably need to file a return. I'll explain each one clearly, give you real-world examples, and help you figure out exactly where you stand. By the end of this video, you'll know whether you need to take action, and more importantly, you'll understand why. So, let's dive straight in. The first thing we need to establish is that not every pensioner needs to file a tax return. If you only receive the state pension and it's below the personal allowance, which stands at £12,570 for the 2024 to 2025 tax year, you typically won't need to worry. Similarly, if all your income is taxed at source through PAYE, meaning your pension provider or employer deducts tax before you receive your money, HMRC usually has all the information they need without you filing a return. But here's where it gets interesting. There are specific circumstances where the normal rules don't apply, and that's what we're focusing on today. The first major trigger is when your income exceeds £100,000 per year. Now, this might sound like a high threshold, but remember, we're talking about total income here. That includes your state pension, any private or workplace pensions, rental income, investment income, and any earnings if you're still doing some work. It all adds up, and you might be closer to this figure than you think, especially if you have a generous final salary pension scheme. Why does HMRC care about this particular number? It's because once your income goes above £100,000, you start losing your personal allowance. For every £2 you earn over this threshold, you lose £1 of your allowance. This creates what's known as the 60% tax trap, where your effective tax rate shoots up dramatically. HMRC wants you to declare this income properly so they can calculate the correct tax, and you need to file a self-assessment return to make this happen. The second trigger involves receiving income that hasn't been taxed at source. This is incredibly common among pensioners and catches many people off guard. Let me give you some examples. Perhaps you rent out a property and receive rental income. Maybe you have savings accounts generating interest that exceeds your personal savings allowance. You might receive dividends from shares and investments. Or perhaps you've done some freelance work or consultancy during your retirement. All of these income sources typically aren't taxed before you receive them, which means HM Revenue and Customs doesn't automatically know about them. You need to declare them through a tax return. Even if the amounts seem small, they can add up over the year, and if they push your total income above your allowances, you'll owe tax that needs to be calculated and paid. The third trigger is particularly relevant if you have a substantial pension pot. If you've taken money out of your pension using flexible drawdown, or if you've accessed your pension savings in ways beyond just taking the 25% tax-free lump sum, HMRC will likely expect a tax return from you. This is especially true if you've triggered something called the Money Purchase Annual Allowance. Here's how this works. Let's say you've taken some flexible income from your pension pot while you're still working or building up other pension savings. Once you do this, your annual pension contribution allowance drops dramatically from £60,000 down to just £10,000. HMRC needs you to declare this through self-assessment to make sure you're not accidentally over-contributing and facing tax charges. Even if you're not planning to make more contributions, that initial flexible access often requires you to complete a tax return for that year. The fourth trigger relates to untaxed foreign income. This affects more pensioners than you might imagine. Perhaps you own a holiday home abroad that you rent out occasionally. Maybe you receive a pension from overseas from when you worked abroad earlier in your career. Or perhaps you have foreign investments generating dividends or interest. Even though you're a UK resident, you're required to pay UK tax on your worldwide income. And foreign income often arrives in your bank account without any UK tax being deducted. HMRC needs you to declare this through self-assessment so they can assess the correct tax liability, taking into account any foreign tax you might have already paid under double taxation agreements. The fifth trigger is about capital gains tax. Now, as a pensioner, you might have built up valuable assets over your lifetime. If you sell assets like a second property, shares that aren't in an ISA, valuable possessions worth more than £6,000, or business assets, you could trigger a capital gains tax liability. Everyone gets an annual capital gains tax allowance, which currently sits at £3,000 for the 2024 to 2025 tax year. This is significantly lower than it used to be, so it's easier to exceed. If your gains go above this allowance, you need to report them through a self-assessment tax return. Even if you don't owe any tax because your gains fall within the allowance, if the total proceeds from your sales exceed 4 times the annual allowance, you still need to report it. This catches many pensioners who assume that because they don't owe tax, they don't need to tell HM Revenue and Customs. The sixth trigger involves claiming certain tax reliefs or allowances that can only be processed through self-assessment. The most common one for pensioners is the marriage allowance. This lets you transfer 10% of your personal allowance to your spouse or civil partner if they earn more than you. While you can claim this online, you'll often need to confirm it through self-assessment in subsequent years. Another example is claiming tax relief on pension contributions if you're a higher rate taxpayer. Your pension provider claims basic rate relief automatically, but if you pay tax at 40 or 45%, you need to claim the additional relief yourself through a tax return. Charitable donations through gift aid work similarly. If you're a higher rate taxpayer, you can claim extra relief on your donations, but only through self-assessment. The seventh and final trigger is if HM Revenue and Customs has specifically asked you to complete a tax return. This might seem obvious, but it's worth stating clearly. HMRC sends out notices to file, and if you receive one, you're legally obligated to complete a return even if you don't think you need to. You might receive a notice because HMRC's records show something that suggests you should be filing, even if their information is incomplete or outdated. Common scenarios include if you were self-employed in the past and haven't formally notified HM Revenue and Customs that you've stopped, if you were a company director, if you've registered for self-assessment previously, or if HMRC has incomplete information about your income sources. If you receive a notice to file and genuinely believe you don't need to complete a return, you can contact HMRC to discuss it, but until they formally agree and withdraw the notice, you're required to file to avoid penalties. Now, let's talk about what happens if one or more of these triggers applies to you. The first thing to understand is the deadline. For the 2024 to 2025 tax year, which runs from the 6th of April 2024 to the 5th of April 2025, you need to register for self-assessment by the 5th of October 2025 if you're new to the system. The actual deadline for filing your online return is the 31st of January 2026, and any tax owed is also due by this date. Missing these deadlines triggers automatic penalties. You'll face a £100 fine if you're even 1 day late, followed by additional penalties if you're more than 3 months late. The fines escalate quickly, so it's definitely worth getting organized early. If you're not confident handling this yourself, there's absolutely no shame in getting professional help. A qualified accountant can handle everything for you, ensuring accuracy and potentially identifying tax-saving opportunities you might miss. The cost of professional help is often well worth it for peace of mind, and their fees are usually very reasonable for straightforward pensioner tax affairs. Alternatively, HMRC offers support through their helpline, and there are various software packages available that walk you through the process step by step. Many pensioners find the online system more intuitive than they expected, especially if their tax affairs are relatively straightforward. One final crucial point. Even if none of these 7 triggers apply to you right now, it's worth reviewing your situation each year. Circumstances change. Maybe you'll receive an inheritance and invest it in income-generating assets. Perhaps you'll decide to downsize and sell a second property. You might start receiving a foreign pension. Tax rules change too, with allowances and thresholds shifting annually. What doesn't require a tax return this year might require one next year. And there you have it, the 7 critical triggers that determine whether you need to file a tax return as a UK pensioner in 2025. Let's quickly recap them. First, income over £100,000. Second, untaxed income like rental or investment income. Third, accessing your pension flexibly and triggering the money purchase annual allowance. Fourth, receiving foreign income. Fifth, making capital gains above your allowance. Sixth, claiming certain tax reliefs that require self-assessment. And seventh, receiving a formal notice to file from HM Revenue and Customs. The key takeaway is this: don't assume that retirement means your tax affairs are automatically simple. Take the time to review your situation honestly against these 7 triggers. If you're unsure, it's always better to ask for clarification rather than risk penalties for non-compliance. If you found this video helpful, please give it a thumbs up and subscribe to UK Pension Hub for more clear, practical guidance on managing your retirement finances. Drop a comment below letting me know if any of these triggers apply to you, or if you have questions about your specific situation. While I can't give personal tax advice in the comments, your questions help me understand what content would be most valuable for future videos. Remember, managing your tax affairs properly isn't just about avoiding penalties. It's about ensuring you're not paying more tax than necessary and keeping your retirement finances on solid ground. Thanks so much for watching, and I'll see you in the next video where we'll be exploring more essential pension topics to help you make the most of your retirement years. Take care.